This is the story of how one man's $100 million mistake led to the creation of the most powerful financial institution in human history. Larry Fink didn't just build BlackRock into a $14 trillion empire. He fundamentally changed how money flows through the global economy. And his decisions now affect everything from your retirement account to the price of gold in times of crisis. When you think about who really controls the financial system, most people point to the Federal Reserve or major banks. But there's a shadow power that's grown quietly for decades, one that now oversees more wealth than the GDP of most countries combined. BlackRock manages $14 trillion directly, but through its Aladdin technology platform, it monitors and analyzes over $21 trillion in global assets. To put that in perspective, that's roughly equivalent to the entire GDP of the United States. And it all started with a catastrophic trading loss that destroyed one man's career and sparked an obsession with risk that would reshape Wall Street forever. Larry Fink was born in 1952 in Van Nuys, California, the middle child in a modest Jewish family. His father Frederick owned a shoe store, and his mother Lila was an English professor. Unlike his academically gifted older brother, Larry struggled in school, which meant he spent his afternoons working in the family shoe store, a chore his more successful sibling was excused from. That early lesson about having to earn success rather than expecting it would prove prophetic. After earning degrees from UCLA, Fink joined First Boston in 1976 as one of the first mortgage-backed security traders. This was the Wild West era of Wall Street, when financial innovation was exploding and fortunes were being made by young traders who barely understood the complex instruments they were creating. Fink thrived in this environment. By 1983, at just 31 years old, he became the youngest managing director in First Boston's history. Vanity Fair reported that he had increased the firm's assets by about $1 billion, making him a Wall Street golden boy. But in 1986, everything changed. Fink made an incorrect prediction about interest rates, and his department lost $100 million in a single quarter. In today's dollars, that's roughly $280 million. "I screwed up, and it was bad," Fink later admitted. The loss wasn't just about money. It exposed a fundamental problem in how Wall Street managed risk. Financial institutions were flying blind, making massive bets without truly understanding their exposure. Fink realized that the entire system was built on quicksand. By 1988, Fink had to leave First Boston. "I did not have the option to stay," he later said, but this setback would become the foundation for something much larger. Fink had developed an obsession with risk management, and he had a radical idea. What if you could create a system that would analyze every possible risk in a portfolio in real time? What if you could prevent disasters before they happened, instead of just reacting to them? Under the corporate umbrella of the Blackstone Group, Fink co-founded BlackRock in 1988 with $5 million in backing from Steven Schwartzman. The company's first employee was Charles Halleck, who bought a single computer that cost $25,000 and was roughly the size of a washing machine. Halleck wedged it between their refrigerator and coffee maker, and on that machine, he started building what would become Aladdin: the asset, liability, debt, and derivative investment network. The whole concept for BlackRock grew out of that experience at First Boston, Fink explained. "We are not going to live that again. We are going to have systems to analyze risk." This wasn't just about building another investment firm. This was about creating a technology platform that could see around corners, anticipate problems, and manage risk on a scale that had never been attempted before. BlackRock's growth was meteoric. 4 years after founding, they had amassed $17 billion in assets under management. By 1999, when they went public, they had formalized the Aladdin platform and were managing assets for major institutions. But the real transformation came through a series of strategic acquisitions that turned BlackRock from a risk management firm into the dominant force in global finance. In 2006, BlackRock merged with Merrill Lynch Investment Managers, doubling their assets under management to $1 trillion. But the deal that changed everything came in 2009, when BlackRock acquired Barclays Global Investors for $13.5 billion. Included in that purchase was iShares, the world's largest provider of exchange-traded funds. Suddenly, BlackRock wasn't just managing money for institutions. They were managing the retirement savings and pension funds of millions of ordinary Americans. The timing couldn't have been better. The 2008 financial crisis had exposed the same kind of risk blindness that had cost Fink his job at First Boston 20 years earlier. But this time, instead of being the victim, BlackRock became the solution. The US government turned to Larry Fink and his Aladdin system to help clean up the mess. BlackRock was contracted to manage $130 billion in toxic assets from the government and Federal Reserve, including securities from the liquidation of Bear Stearns and AIG. This was the moment when BlackRock evolved from a private asset manager into a quasi-governmental institution. When the financial system needed emergency surgery, the government didn't turn to traditional banks or other investment firms. They turned to Larry Fink and his risk management technology. The same pattern repeated during the coronavirus pandemic in 2020, when the Federal Reserve again contracted BlackRock to help purchase distressed securities. What makes BlackRock unique isn't just its size, although the numbers are staggering. As of December 2024, BlackRock manages $14.042 trillion in assets, up 21.6% from the previous year. That's more than the combined GDP of China and Japan. But the real power comes from the Aladdin platform, which now manages $21.6 trillion in assets across the global financial system. This includes money from CalPERS, the California Public Employees Retirement System, with $260 billion. Deutsche Bank with 900 billion euros, and Prudential with $700 billion. Even the Bank of Israel uses Aladdin to manage its foreign currency reserves. One of BlackRock's data centers in Wenatchee, Washington, operates around 6,000 computers that process this information in real time. Every trade, every risk calculation, every portfolio optimization flows through these servers. The system tracks about 30,000 investment portfolios and can simulate thousands of market scenarios to predict how different events might affect asset prices. It's like having a crystal ball for the global economy, and Larry Fink controls the switch. But here's where it gets really interesting for anyone concerned about currency debasement and economic collapse. Through iShares, BlackRock has become the largest provider of ETFs in the world, with $4.2 trillion in assets. These aren't just abstract investment vehicles. They're the funds that hold your 401k, your pension, your retirement savings. When you buy an S&P 500 index fund, you're likely buying a BlackRock product. And because BlackRock votes the shares in these funds, they effectively control voting power in thousands of companies. Together with Vanguard and State Street, the big three asset managers collectively own large stakes in more than 40% of publicly traded U.S. firms and 88% of the S&P 500. This concentration of power has raised serious questions about market manipulation and corporate control. Senator Elizabeth Warren has suggested that BlackRock should be designated too big to fail and regulated accordingly. Senator Bernie Sanders has called the concentration of assets held by the big three obscene. For investors worried about currency debasement, BlackRock's influence extends into the precious metals markets as well. The firm manages significant ETF positions in gold and silver, and their trading decisions can move prices. When BlackRock's algorithms detect inflation risks or currency instability, their automated trading systems can execute massive positions in precious metals within seconds. This gives them enormous influence over the very assets that traditional investors turn to as hedges against monetary debasement. The relationship between BlackRock and government has become even more intertwined in recent years. Larry Fink's long-standing relationships with senior officials have led to questions about potential conflicts of interest, especially regarding government contracts awarded without competitive bidding. When financial crises hit, governments don't shop around. They call BlackRock. This creates a feedback loop where BlackRock becomes more powerful with each crisis and more indispensable for managing the next one. Recent developments show BlackRock expanding its reach even further. In 2024 and 2025, the firm completed a series of major acquisitions. Global Infrastructure Partners for $12.5 billion, HPS Investment Partners for $12 billion, and Prescient for $3.2 billion. These deals aren't just about growth, they're about gaining control over the private markets, where much of the world's real assets are traded. Infrastructure, real estate, private credit, these are the tangible assets that hold value when currencies collapse. Larry Fink's 2025 annual letter reveals his vision for the future of investing. Instead of the traditional 60-40 split between stocks and bonds, he's advocating for a 50-30-20 allocation that includes 20% in private assets like infrastructure and real estate. He argues that capitalism has worked for too few people and wants to democratize access to these alternative investments. But critics see this as BlackRock trying to funnel more money into the private markets, where they have less competition and can charge higher fees. Most significantly for the gold and silver community, BlackRock has embraced cryptocurrency in a big way. In January 2024, they launched the iShares Bitcoin Trust, which became the world's largest Bitcoin fund with nearly $20 billion in assets by May. Fink has become a vocal advocate for tokenization, stating that every stock, every bond, every fund, every asset can be tokenized. If they are, it will revolutionize investing. This represents a fundamental shift in how we think about money and value storage. BlackRock isn't just managing traditional assets anymore. They're helping to create entirely new asset classes. When the CEO of the world's largest asset manager starts talking about tokenizing everything, it's worth paying attention. This could represent either the next evolution of sound money principles or the final digitization of wealth that makes government control even easier. The firm's influence on corporate behavior through ESG investing has been particularly controversial. As an early advocate of environmental, social, and governance factors, Fink pushed companies to adopt climate-friendly policies and social justice initiatives. But facing backlash from Republican states, BlackRock has significantly reduced its ESG advocacy. Their support for environmental and social shareholder proposals fell from 47% in 2021 to just 4% in 2024. Several states, including Indiana and Tennessee, have withdrawn pension funds from BlackRock over ESG concerns. This political pressure reveals both the extent of BlackRock's power and its limitations. When state treasurers can force a $14 trillion firm to change its voting policies by threatening to withdraw pension funds, it shows that political accountability still exists, but it also demonstrates how dependent the entire retirement system has become on BlackRock's decisions. For investors concerned about systemic risk and currency collapse, BlackRock represents both a threat and an opportunity. On one hand, the concentration of so much financial power in a single institution creates systemic risk. If BlackRock's algorithms malfunction, or if the firm faces a crisis, the ripple effects could destabilize global markets. The firm's close relationship with government also means that political decisions increasingly influence market outcomes. On the other hand, BlackRock's massive size and technological capabilities give it unique insight into market conditions. When BlackRock's systems detect inflation risks or currency instability, savvy investors can potentially position themselves accordingly. The firm's embrace of Bitcoin and other alternative assets also suggests that even mainstream institutions are preparing for monetary uncertainty. The story of Larry Fink and BlackRock is ultimately a story about the evolution of financial power in the modern world. What started as one man's determination to never repeat a costly mistake has become a global institution that shapes markets, influences governments, and manages the retirement savings of millions. Whether you see this as financial innovation or dangerous concentration of power may depend on your perspective, but there's no denying its significance. As we face an uncertain economic future with persistent inflation, massive government debt, and increasing geopolitical tensions, understanding who controls the flow of capital becomes more important than ever. Larry Fink may not be a household name, but his decisions affect every portfolio, every pension fund, and every retirement account in America. In a world where algorithms increasingly drive market behavior, the man who controls the most sophisticated risk management system on Earth wields unprecedented influence over the global economy. The question for individual investors isn't whether BlackRock will continue to grow and consolidate power. That seems inevitable. The question is how to position yourself in a financial system where a single firm's algorithms can move markets with the speed of light, and where the line between private finance and government intervention has become increasingly blurred. In this new reality, understanding the forces that drive Larry Fink's empire isn't just interesting, it's essential for anyone seeking to protect and preserve wealth in an increasingly uncertain world.